Sure. Of course, we know the government manipulates figures. The inflation rate in terms of consumer price index is higher than they report. But look around you. I mean, gold is off $600 from its high. Silver's down 60%. This is the metal that was supposed to go to $200 an ounce is 20 bucks. You look at interest rates, and for the past 10 years, the hyperinflationists have been saying, oh, with all this money creation, interest rates are going to be in double digits, and they fell to the lowest level in history. And this was right along the predictions we were making. You look at commodities, they've been languishing since 2011. All kinds of indicators to me show that there is not the response that the hyperinflationists were expecting. And this is in the face of the Fed inflating the base money supply at 33% a year. That's just huge. So obviously there are tremendous deflationary pressures that are countering this inflation of base money. But my argument goes a lot deeper than that. I think the banks don't want to go bankrupt. And a lot of people said, in fact, Bernanke himself promised that he would drop money from helicopters. And is that really what they've been doing? Well, in 2008, they pretty much did that. They supported all their buddies, willy-nilly during that period. But very rapidly thereafter, they traded all that debt for U.S. government bonds, government-guaranteed mortgages. So they're doing the same thing the Fed's always been doing, which is buying the safest possible debt. They're not going to go up and buy all the bad corporate debt or all the bad mortgages that are owned by the banks. Now, something that I more or less anticipated, I think shocked a lot of people, was what happened in Cyprus. I mean, where was all the money printing? Where was the central bank, the ECB coming in, on a white horse saying, we're the lenders of last resort? Where's the money dropped from helicopters? What they did was they came into the country of Cyprus and basically said, we are seizing your bank accounts. In other words, we're not bailing you out, we're taking your money. These are still bankers at heart, and they don't want to go under, they don't want to go bankrupt, they're not giving money away, they want to be paid back. I think eventually the same thing is going to happen in the United States, that there's no such thing as magic money, no such thing as infinite credit. And when this thing rolls, it's going to be a sight to see. But let's start with the idea that he's promising interest rates will stay low and they'll keep them low. I don't think they have the power to do that. Recall, it was December 2012, last year, when Bernanke came out and said, our QE policy is designed to keep long-term interest rates down. Well, they had already started up in the summer of 2012. They've been soaring ever since he made that comment. So obviously their policies aren't working as designed. All of the machinations that they're going through are leading to a weaker and weaker and weaker situation with greater and greater debt. The more they keep the bad guys liquefied, the more debt expands. And you're getting some of these things like we talked about before, like student loan debt and private equity companies, paying themselves through more and more ridiculous bonds that aren't going to be paid off. So the situation gets worse and worse and worse, and I don't think they can ultimately control it. I think ultimately the market is going to start demanding higher rates. And this happens in countries that are in trouble. It certainly happened in Greece before things blew up there. So rising interest rates to me are not the result of an extremely healthy economy, which is what most economists think. I don't think they're an indication that hyperinflation is coming, which is what most of the bears think. I think the rise in rates now that surprised the Fed and virtually everyone else are the early hint that all the debt's in trouble. And people are going to start demanding higher rates because they're going to start worrying about principal. Now, this is pretty much off the radar, because if you look at the sentiment indicators in the U.S. stock market, they are off the charts and have been for 5 months. In fact, we follow up to 22 different sentiment indicators, every one of which reached extreme record highs or matched record highs being 2007 and 2000 in the past 4 months. So we're back at another 2000 juncture, 2007 juncture, when people are absolutely optimistic about potential stock market gains. They're buying junk bonds like crazy. In fact, even though we're off the highs in junk bond prices, the sales have continued to be very, very strong. So the optimism and confidence out there is tremendous. It's historic, and it's the same level it was in 2000 and 2007. So we've got a double whammy coming. Too much optimism means people are taking all these investments on. And the second one, as you pointed out, is the underlying system is rotten and isn't going to be able to support these debts and the interest payments, or eventually, I think, even the principal payments.
You say we're going to drop big. Give us a worst case scenario for 2014.
Well, first thing I want to say is I think that we are within 0 to 3% of the high for the move up from 2009. So it's getting very, very old. I think 2014 is going to not only be a down year, but a very large down year. First of all, I want people to understand why I've got this opinion. In 2000, we had record sentiment readings in terms of optimism. In 2007, we had the same thing. We are now seeing for the third time, and I don't think very many people expected that, extreme manic type sentiment readings. Let me just give you a couple of quick ones. There's a weekly poll of active investment managers. They usually say they're 80% invested, 90% invested, or whatever. For the first time ever, they've reported a 104% invested. That means they've got more money in the market than they have under management. That means they're borrowing a bit. And the Ridex funds, you know, people can buy not only long and short funds, but they can buy leveraged funds. They can be 200% long or 200% short. When you look at the amount of money in the leveraged long funds, right, it's 12 times what it is in the leveraged short funds. As you also know, margin debt is at a new all-time high, and I think that's masking some of the debt that the public is going into because they're buying some of these leveraged funds.
You're just saying there's too much giddiness to the point where people are borrowing, professionals are borrowing money to go long this market, and even individual investors are borrowing. So we've set up the perfect storm for the perfect crash, which would land us where?
That's half of the perfect storm. The other half is the upside momentum in the market is actually slowing. Not many people know this because the momentum of optimism is increasing so fast. But if you work at 26-week rate of change on the S&P and the Dow,
Robert, we've got just 30 seconds left. The Dow is up 72 points. We're at 16,570. The market's rocketing to the upside. You are known for your bear calls. Please give us a downside target for 2014.
All right, we're within 3% of the high, and I think in 2014, 2015, we'll take out the 2009 low in both the Dow and the S&P.